The topic which I am going to deliver is credit creation by commercial bank. A commercial bank is called a dealer or creditor. It can create credit, can expand the monetary base of a country. It does so not by issuing new money but by its loan operations. Banks create money on the basis of the cash deposits. The process of credit creation is that the depositors thinking they have so much money with the banks and borrowers from bank say they have so much money with them. Summing the two, we find an amount more than the cash deposit. Suppose a bank receives a sum of rupees 1000 as a deposit, keeps with it 20% as a CRR and lends the rest. Depositor will claim he has 1000 and bank borrow to the clients. The total money supply appears to be 1800 only. It is a credit creation by a single bank. The above example can be extended to cover the banking system as whole. Suppose 800 is deposited to another bank. This bank's base will now expand it. It will keep 20% of 800 as cash reserve and will lend 640. This sum is redeposited to the third bank which keeps 20% of 640 and grants a loan of 512. This process will continue and the amount of fresh deposit will go on falling. It will come when deposited sum will be equal to CRR. The process will come to an end. Limitations of credit creation. Size of the cash reserve ratio. Much depends on the mix of the cash reserve ratio. Credit creation is inversely related to CRR. CRR is a minimum fraction of the total deposit of customers which commercial banks are required to hold as cash, either in cash or as a deposit with the central bank. It is set as per the guidelines of the central bank of the country. Creation of depends upon the amount of loan given. If the borrowers cannot offer security, the bank cannot lend it. Size of the cash deposit. Size of the cash deposit is also important in this content. The smaller the cash basis, the smaller scope a bank gets for credit creation. If people prefer physical assets or prefer to keep cash in their hand, bank deposits suffer much, so bank cannot lend much. Acceptable securities. A bank can lend money against acceptable securities. A borrower gets a loan from a bank against some securities, the value of which must be equal to the amount of the loan. Controlled by the central bank. A central bank possesses certain instruments. By the use of these, it can increase or decrease the credit created by banks. Credit controlled by the central bank. A central bank possesses a number of instruments for controlling credit money. These are two types: qualitative and quantitative. Quantitative technique seeks to regulate total quantity of credit, while qualitative measures are the availability of credit. Bank rate policy. As a banker's bank, a central bank lends money and rediscount the bill of commercial bank. The rate of interest charged by the central bank is known as the bank rate or discount rate. By manipulating bank rate, the central bank can regulate the credit creating power of members' bank. If bank rate is raised by the central bank, commercial banks are to borrow at a higher rate. Then they will increase the lending rate. This rate is known as the market rate. The difference between market rate and the bank rate is the profit margin of the commercial bank. When bank rate rises, market rate also rises and vice versa. Demand for bank loan will reduce. On the other hand, for credit expansion, bank rate is reduced. The effectiveness of this technique depends on the extent to which commercial banks depends on the central bank for loan and rediscounting. If banks can collect funds from other sources at relatively cheaper rate, they need not depend the central bank credit. Again, investment opportunities are not present. The market demanded for credit will weak. Then the bank rate may the bank rate may not raise the level of bank credit. Open market operations. It implies purchase and sale of securities in the stock market. When the central bank appears in the market as a seller of government securities, people will buy such securities by withdrawing money from banks at the banks themselves invest in such instead of granting loan to public. In either case, the power of creating credit will be restricted. On the other hand, if central bank buys securities, money flows out, thus enlarging the cash balances of the member banks. Credit expansion depends upon the depends upon the external business environment and borrowers' attitudes over such banks have no influence. Variations of reserve ratio. Commercial banks are legally bound to keep a portion of the